Hell is coming. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, with the new year starting, the unexpected is about to send the global economy crashing, and you're not going to believe what just happened and why it's going to send the global economy spiraling into an abyss. Now let's over to Bloomberg, where we picked today's story up with a headline: Maersk halts Red Sea shipping as U.S. Navy sinks Houthi boats. And this is something I want to kind of revisit because this is all about global trade. Of course, we know that this is about, the Houthis wanting that waterway and to control it, and the U.S. wanting passage. But in the end of the day, this is all about global economy and the commerce that transports through the Red Sea, and you can better believe the U.S. is going to make sure it stays open. As the latest attack undermines efforts by Washington to reassure shipping companies that it's safe to sail through the Suez Canal and the Red Sea, a passageway for nearly 12% of global commerce. So you can imagine the U.S. Navy is going to put that whole section of the world on lockdown in the very near future and make sure at any cost that those ships make it through safely, and that everyone believes that will happen. Because again, this is about the global economy. Those goods need to flow from the east to the west, and the U.S. will do anything to make sure that happens. The U.S. set up Operation Prosperity Guardian to secure navigation. Notably, look at the term Prosperity Guardian, because you know what? If U.S. consumers do not get these goods, prosperity in the U.S. goes down. This is not just a play on words. It's very meaningful here. To secure navigation as Yemen-based Houthi rebels show no signs of stopping attacks designed to pressure Israel into a ceasefire in Gaza. You can better believe that's going to come to an end very soon, as prosperity in the U.S. is really all that matters to the government. The U.S. overtakes China as South Korea's top export market. So now as we move into our lead story today, the unexpected has now happened. We've got this data over the weekend, and it is outright shocking what is happening. So let's take a look at what's going on here in China as we continue with this global trade theme, as South Korea now has sold $11.3 billion in goods to the U.S. in December, compared with $10.9 billion to China, this according to the Trade Ministry. The switch in positions came as South Korea's overall exports rose 5.1% from a year earlier, a third monthly increase after a year-long slump. And now, does this mean the end, of course, China and their global export powerhouse? Well, not so quickly here. You have to remember that China was in the midst of their COVID lockdown protocols. They're now out of that. And what are we finding? They came out into a slowing global economy. So they're trying to get back on their feet. South Korea just happened to be, in this case, at the right place at the right time. But if you think China is going to let them hold that crown, well, not so fast. While exports to the U.S. have increased from a year earlier for a fifth month, suggesting that, of course, the U.S. economy is rebounding, but not for long, as you'll soon see. The South Korea said shipments to China also continue to improve. Meanwhile, South Korea's overall imports declined 10.8% from a year earlier, with trade surplus widening to $4.5 billion. Now, imports matter because it's all about internal demand for a country. And if demand goes down, well, inflation comes with it. This is something, of course, we know that these central elites, they do not understand. They think that inflation has factors beyond the very simple, that if consumers demand less products and services, well, prices don't keep going up. And here you can see imports of goods and services in blue against the U.S. Consumer Price Index in red, both on a year-over-year rate of change. And notably, this is imports into the U.S. And you can see the beautiful relationship where, in generally most cases, imports lead the Consumer Price Index with a nice bit of a lag here, according to the CPI on the inside, that as import prices go down and of goods and services, as well as the volume of that, what it tells us that the price pressures follow. That eventually is picked up by the government data, suggesting that, as we know today, that coming into the next several months, that while there could be some effects on the Consumer Price Index that cause it to maybe nudge higher, the more forces to the downward side. Of course, we look at imports of goods and services, tell us that the CPI is likely to come down and hit the Fed's target. Now, you can imagine they'll be celebrating, but as you'll see, it won't be for long. As China is also ramping up domestic production of goods as it moves up the value chain, now coming full force at South Korea. And one key area that China is focusing on is semiconductor and smartphone manufacturing, a development that's contributed to slump in sales of goods made by Samsung and other businesses. But now we've moved forward into what really is kind of shocking that happened here over the weekend as China factory activity posts the worst contraction in 6 months. Now you talk about the unexpected, because what did we hear? That yes, we knew we were going to have the back to school and the holiday season, but we were going to have a first quarter slowdown. But mind you, even if the global economy slows down, what you should be seeing as demand start to build up in the pipelines as we hit this soft landing and come rocketing out of it. But as we made the case on the show, with the inverted yield curves and money curves, the contraction of global credit, the odds of an actual expansion here, a soft landing, is pretty much zero. We're getting the case now that these global currency shortage are starting to hit China. That's where we expect it to start, and then watch, it's going to flow throughout the rest of the world. But that's something that will lead to lower interest rates than you could be taking advantage of, as we talked about with our CTA Timer Pro. Now we look at how the machines are positioned here, and what makes this report so special compared to everything else you could find on the market is we run a historical overlay. So when we tell you something's at the extreme bottom, it means historically it's at a very low point. And if you're a trader, you know that's a great way to find an upside return. Well, we found that with TLT going back to November 2nd. It came off of this max short position, and starting some point here in January when the programmer gets done, we're going to make using this report so super simple. We're going to give you the trades as they happen. And if you would have paired that with the Momentum Timer Pro, this thing looks at the MACD, the Stoch, and all of those other technical indicators like the RSI. We blend them all together, smooth them all out, and what did we see on November 2nd? One daily count on the buy signal validating that momentum was shifting off of this sell positions over the 1, 3, and 6 month period. You would have been a buyer of TLT at market open right here on November 2nd, and today you'd be up 14.1%. And looking at this show as we talk about the global economy slowing down, thinking that means nothing but profits in your account. That's what we want to do for you. And right now, as of today, I put up 3 more coupon codes for a free month for each product. You have to get them before they're gone. If you get to checkout and there's nowhere to put the code in, because 3 people beat you to it. The official Manufacturing Purchasing Managers Index declined to 49, this according to the National Bureau of Statistics, as they said on Sunday. That was weaker than, of course, median forecast of 49.6, suggesting that, as we know, when you see these figures under 50, it denotes a contraction. So the Chinese manufacturing sector has resumed its contraction after all of this hope. You may remember, in the last couple of months, it was just getting into a very slight expansion, and everyone was super optimistic. And we said, don't actually expect it to last. And sure enough, as we head into the new year, well, all that hope is turning to the downside. As a gauge of non-manufacturing or the services activity rose to 50.4 from 50.2, suggesting just the ever so slightest expansion over the prior month. This happening in November, boosted mostly by the construction sector as government-led infrastructure investment accelerated in recent months. Services activity, here we go, remained in contraction with an underlying measure staying at 49.3, suggesting broadly that the Chinese economy is indeed contracting. If it wasn't for the construction sector, we would see both indices down. Not a good sign, because we know that Xi Jinping needs to turn this economy around, but what China is suffering here is just an offshoot of what's going on around the world, that economies everywhere else are indeed slowing down. And when you're this world's largest exporter, well, you're at the mercy of a lot of other people. And here you can see, when we look at China alone, why does it matter? U.S. imports of goods by custom basis from China, that's shown in blue, against the U.S. Consumer Price Index. And as, of course, China's economy slows down, and this is a key part, because if their manufacturing is entering contraction, where do they export to? Well, obviously a lot of it is to the U.S. So if we're importing less goods from China starting the new year, what does that mean for the Consumer Price Index in red? It means it heads lower. Again, you see this beautiful relationship, the Consumer Price Index lagging Of course, U.S. imports by China by a healthy margin, suggesting we already know where consumer prices are going. But we can also look at this from the perspective of China. Here we're going to look at the U.S. data, but put us in their shoes. If you look at current general activity, this is the diffusion index from the Philly Fed Manufacturing Index against exports from the U.S. And what do we know? That as, of course, general activity in the manufacturing sector goes down in blue, what should follow is exports go down. So this is suggesting us that China is in big trouble here, and this is not expected. This is going to impact the entire global economy as we see this hope for a soft landing in the data. Remember, the last couple months of the year, everyone started to get a little bit excited. We said, wait for it. It's going to roll over. These global currency shortages matter. It's starting to, and this is going to lead to one thing and one thing only. The PMI figures provided more signs of weakness in China's economic recovery in the final months of the year. They're also likely to add pressure. Here we go. Again, the unexpected fiscal and monetary policymakers to act urgently. Just wait till this comes to the U.S. and the Fed is aggressively cutting rates. It will likely happen big time in this coming year here. Even though the Fed only says 3 cuts, we're saying it's going to be a whole lot more. And here we see an analyst in a separate statement said, quote, falling overseas orders coupled with insufficient effective domestic demand was the biggest trouble reported by some companies in the official PMI survey. The key part here is falling overseas orders. Tells you demand from the U.S., Europe, and other industrialized countries is going down. That's not a good sign at all, of course, for that soft landing that everyone is betting big on. The textile and non-metal mineral product sectors were unable to make use of their full capacity due to subdued demand. And weak demand and sluggish confidence have also been reflected in deepening consumer price deflation and shrinking imports. Again, telling us that the global economy is indeed heading back into contraction. The worst property downturn in modern Chinese history is expected to persist, and wait till we show you what's coming, because that's going to further curb demand for goods from furniture to home appliances. Again, as everything has started to slow down, you're going to watch the global economy in a synchronized fashion. Remember, we're all tied together now. We avoided this in 2015, 2016. The pandemic reset all these countries' economies back to the starting gate at the same time, and we took off virtually all together. Now we're slowing down together. This is going to be the first globally synchronized recession in history. Meanwhile, Xi Jinping vows to strengthen economic recovery after a tough year, saying the nation will surely unify as Taiwan election looms. Well, I'm sure he's going to be wrong about that. And while China's most powerful leader since Mao used his annual New Year address to trumpet his nation's achievement, he also conceded that, quote, enterprises had a tough time and people had difficulty finding jobs and meeting basic needs. Now, when you're in a government position, particularly as high as he is, well, of course, you're worried about re-election, which we know is something, well, he doesn't have to worry about. He has, more importantly, the problem is, if his economy slips into a recession, people might choose to overthrow his power and kick him out, and that's not exactly what he wants. He's got to get this turned around, because if people are having trouble meeting basic needs, well, it doesn't bode well for his future. We will consolidate and strengthen the minimum of the economic recovery and work to achieve steady and long-term economic development, he said. Well, that sounds very politicalized statement to me, as signs of weakness in the economy remain persisting. As we talked about, the factory activity now at the lowest level in 6 months. And despite that, Xi said on Sunday he touted Chinese manufacturing prowess and rattled off a list of homegrown projects, including the domestically built C919 passenger jet, a made-in-China cruise ship, and the nation's space programs, manned submersibles, and electric cars. And as we pointed out, that China is not about internal demand. Now, they have enough people, they should be able to make this work, but they can't. And so all of the things they're trying to do, I want you to see that it's not having an effect, because their manufacturing sector is turning down. It's all because they're so closely tied to the global economy, everything outside of their country. As the world's largest exporter, they're doing everything they can to stimulate internal demand. It's not working. Look for more, because their housing market is about to blow up. As China home sales fall again as policy shifts fail to stem decline, we said this was going to happen, and it did. The value of new home sales among the 100 biggest real estate companies fell 34.6% from a year ago. That is staggering compared with a 29.6% decline in November. Remember, they were doing things to try to stimulate the housing market that, of course, you may recall, Xi Jinping wanted to pull the reins back. He wanted to slow down speculation. Well, he got a whole lot more than that. And of course, we know that the property developers are largely insolvent. They're tied to the banks, which means they're insolvent. These property developers go and watch out. Of course, you're going to see the ripple to the global economy. And that puts major developers' full-year sales 16.5% lower than last year, worse than the institution's earlier estimate of a 15% drop. Even December sales were up 15.7% compared with the previous month. Still not enough to change the broad slowdown. And the officials in 2 mega cities cut down payment requirements, now getting desperate to do anything to save these property developers for some home buyers, and also change the definition of so-called non-luxury homes, effectively allowing more residents to qualify for lower mortgages. The changes follow central government guidance to cut down payment requirements that back in August. And again, you want to talk about why the Fed is going to be back at zero, because eventually the U.S. housing market is going to see the same problems. Central bankers around the world are going to have one conclusion and one only, and that's to take rates back to zero. The problem is we've been there not just once, but twice. Third time, not going to work. They're going to have to find a way to take them negative to get people to refinance and take out loans. It's just not going to work. And despite policy changes, the market remains sluggish, when home sales plunging in 20 out of the past 24 months. As buyers remain on the sideline, they say spooked by price drops, construction delays, and company defaults. How about this instead? A slowing global economy that's affecting, of course, Chinese manufacturing and services sector. If I was them, I wouldn't be buying too, because what are they worried about? Well, they're probably worried about losing their job. And the government signals stronger support to ease developers' funding woes, as China's vice housing minister earlier this month pledged to avoid a cascade of debt defaults. Well, I wish him good luck with that. As last month, authorities created a draft list of developers eligible for bank support and may force lenders, is correct, not allow, because they wouldn't do this, to offer them unsecured loans for the first time. Do you really think that banks are going to be like, hey, we cannot wait to lend these insolvent property developers money on an unsecured basis? Look, bankers are not that dumb. We know the Chinese banks are already too heavily tied to the property developers. It's not a good thing. They're going to have to be forced by the government to do this, which means when it doesn't work, and we know it won't, well, there goes the banks and the property developers in China. There goes our whole economy. And when they go down, everybody around the world, because again, we're all tied together now, will go. But hope still remains in the U.S., but for how long? As U.S. job numbers to show healthy hiring, easing pay growth, well, the hiring doesn't matter. The pay growth is all that really matters to me. And the government data on Friday are projected to show payrolls in the world's largest economy increased by 170,000 in December, which would be quite a nice number, giving the Biden administration at least some leeway to tout there was 2.7 million jobs created. Meanwhile, the median forecast in Bloomberg calls for a 3.9% increase in average hourly earnings from a year earliest, which will be the smallest annual gain since mid-2021. Of course, the unemployment rate is expected to tick up and put the Federal Reserve on ice. The issue here is the average hourly earnings. I've been making a case this is going to continue to go down. That's why demand is falling, because inflation still is running too hot. And sure enough, let's take a look. When we see average hourly earnings of production and non-supervisory employees, this in blue against the consumer price index. Remember, if companies don't have the pricing power to raise wages, well, they can't. And so as consumer price demand goes down, as the consumer price index slow, well, that means, of course, average hourly earnings, the pay rate starts to slow down. We see that beautiful relationship between these two, noting that, again, big pay increases now are a thing of the past. And while the pace of hiring is moderating, a resilient labor market supports the views that the economy will continue to expand in 2024, albeit at a slower rate, which is consistent with the Federal Reserve's latest economic predictions. As Fed officials see inflation cooling, that is not a chance at all. There's no sign that the labor market's going to hold up, because of the idea that demand can go down and that you can see the labor market stay strong. It's really simple math. Managers and company owners are going to look and say, hey, you know what? I don't have enough work for all my workers. and they're not going to keep paying all of them. Some of them are going to go. And here you can see, now we look at total compensation, taking average hourly earnings, multiplying that by average weekly hours of production of non-supervisory employees, putting that on a year-over-year rate change. And as people make less, something very shocking happens in the economy as we see more layoffs. That's shown here in continued claims. Notably, we're seeing at 1.88 million claims, historically very low. It's that, of course, as gamma, that move off of the bottom here that really matters. Well, we can note that as total compensation goes down, that's hours worked, of course, and hourly pay. What that means is more people are going to hit the unemployment line, and this whole notion that the Federal Reserve has engineered a soft landing and they've got, of course, the labor market to hold up, that will be just a fantasy in the books that we'll know about in the coming years that tell us that everything the Fed does not work. And that means China's going down, the U.S. economy is going to follow it down. It's all going to happen this year. Just wait and see. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.